John, the Bank of Canada recently signaling that interest rates will go up by 1%. What does that mean for your business?
Well, I mean, we're seeing the impacts of higher interest rates on the ground, quite frankly. And we've been seeing it for the past month or so because 5-year rates have been increasing, of course, well ahead of the Bank of Canada raising their rate. And of course, that's impacting people's ability to take on debt, people willing to borrow. And we're basically seeing a pretty rapid decline in activity and demand in the housing market right now.
So I guess listening to what you're saying, is it enough to ultimately cool the housing market, or will it just ultimately make home ownership just that much more expensive?
You know, it's tough to say because it's early days right now. I mean, certainly on the ground, we're seeing some homes selling for a little bit less than what they would have sold for a couple of months ago, but that's primarily because some of these homeowners have bought and they're pretty eager to sell. So as we move into the summer months, I mean, it's really going to depend on how much demand this takes out of the market and how eager sellers are to sell. You know, typically in slowing markets, sellers are pretty stubborn. But if many of those sellers have bought and they have to sell, they have no choice. We could see some downward pressure on prices.
So you mentioned that summer, and of course, traditionally we think of that spring housing market. Of course, this now probably changes that picture for people applying for mortgages, and of course, with that added stress test, qualifying for those numbers, I would expect that'll just put more downward pressure. How do you see this playing out?
Yeah, I mean, absolutely. I mean, I think some people still have some rate holds, and maybe some people are pretty eager to kind of buy a home, before their rate holds expire. But you're right, as we move into the spring market, with 5-year rates kind of going above 4%, it's going to impact people's, the stress is one thing, people's ability to borrow, it's going to impact, but also people's willingness to take on debt. Last year, people were maxing out on how much they could borrow because rates were below 2%. So it's a lot easier to take on a lot of debt. Today, people may not be as willing to max out on how much they're even able to borrow based on the stress test because their payments are going to be significantly higher.
The budget was recently tabled. Some measures in there for housing. What do you make of that?
Yeah, I mean, nothing really material for housing. I mean, unfortunately, I mean, I think a lot of the measures that were put forward. I mean, the big one that caught a lot of headlines is of course the foreign buyer tax. I mean, assuming they even introduce that, there are going to be a lot of loopholes in that it's unlikely to have any meaningful impact. And a lot of the other measures, the tax-free savings account for home buyers, I mean, is great. But again, it's not really a solution to the high home prices we're seeing today.
What is the solution, John?
Well, I mean, I don't think there's any one silver bullet solution. I mean, certainly, something like a foreign buyer tax, is a small measure that would have helped if there weren't so many loopholes and they were serious about it. I mean, I think, we have a very strong, a lot of the data shows a very strong investor-driven market for single family homes in Canada. And I think one of the smarter policy measures would have been something that they floated doing, which was potentially tightening credit on secondary property. So making it a little bit harder for mom and pop investors to be buying investment properties, which of course takes a little bit of demand out of the market, makes it a little bit easier, for first-time buyers to get into the market.
When you ultimately look at that horizon, the Bank of Canada has signaled that rate increases are coming in fast and furious. How is that going to change everything going forward?
Well, yeah, I mean, it's not going to change. I think a lot of people worry it's going to lead to, a crash in the market because there's going to be a lot of distressed sellers. I mean, that's not going to happen. People have their interest rates, even people who are on variable rates for the most part. Their mortgage payments not going to change. Just the portion going towards interest and principal will change. So we're not going to have a lot of distressed sellers. What we're going to probably have is a lot fewer buyers out there. I mean, and partly because COVID pulled a lot of demand forward, which is why we had this demand shock over the past 2 years of people buying homes. People who maybe were planning on buying far later just jumped in very quickly. So the combination of the fact that it pulled demand forward and the fact that we have much higher interest rates and in an environment where home prices are so expensive and there's these inflationary pressures, that could definitely put a little bit of pressure on home prices as we move into the second half of this year.
John, you and I have often talked about the three levels of government stepping into Canada's housing market. We saw what came out of the federal government recently. What else can we expect?
Yeah, so I mean, the provincial government did release their housing plan recently, and we're not seeing very much from this current Ford government. I mean, they're planning on, they say, tackling kind of red tape, but that's not enough to drive more housing completions. And when we think about the provincial policies, this is, really the area where the province has more influence. It's in driving more housing construction so that Canada, has enough homes to meet this rapidly rising population boom we have. And we're not seeing that from this current government. We'll see what the Liberal and NDP platforms end up looking like later this year.
John, you will know this, I guess, better than most. What is your data telling you in terms of the cycle, in terms of where we're headed now? How long will that last? And then when will we see that, I guess, uptick again?
Yeah, I mean, it's a hard question because, the market's slowing down pretty rapidly. The momentum is slowing down. And of course, when we're in these periods, it's not all economic factors that impact the housing market. I mean, part of it, of course, are behavioral factors and people's beliefs or concerns or thoughts about the future direction of home prices. And, if we start to see some easing in prices over the next few months, when buyers start becoming more pessimistic, that ends up being sometimes a self-fulfilling prophecy as buyers wait on the sidelines for potentially prices to fall. So we don't really know yet, but we do know that the market's slowing down. We'll have to see how, stubborn sellers are and how eager buyers are as we move into the second half of this year.